Welcome to Chapter 12, Annuities. This has a lot of similarities to Chapter 11, but there's a lot of language in this, and I encourage you to take notes and email me if you have any questions and attend Zoom sessions. All right. Section 1 is the future value of an annuity. There's two types, ordinary and annuity due. Section 2, we're talking about the present value of an annuity, both types, an ordinary and annuity due. And this third section is sinking funds and amortization. So we're going to go through examples. Examples with numbers are always easier to understand, but make sure that you are trying these examples on your own as well, and take advantage of the homework to help you understand everything, and going through the answer keys and the explanations and everything that you can sink your teeth into to understand. All right, so there's a couple types of annuity: future value of an annuity, ordinary, and annuity due. So annuity is a payment or receipt of equal amount of money per period for a specific amount of time. A simple annuity is an annuity in which the number of compounding periods per year coincides with the number of annuity payments per year. Complex annuity is an annuity in which the annuity payment and compounding periods do not coincide. Annuities certain is annuities that have specified number of time periods. Contingent annuities are annuities based on an uncertain period of time, such as the life of a person. So people pay annuities or pay into annuities or have annuities paid out to them, but it's unknown how long. It depends on how long they live in many cases. Okay, so here are two visuals about the future value of an annuity and the present value of an annuity. Future value is where the future value is unknown, but the payments are known. And present value of an annuity is when the present value is what is unknown, but what our payments are known. And so we're going to go through some examples to put some numbers to these kinds of concepts. So there's different annuity payment types. Ordinary annuity is an annuity that is paid or received at the end of each time period. End, and that's the critical part here, end. Annuity due is an annuity that is paid or received at the beginning of each time period. Future value of an annuity is the total amount of the annuity payments and the accumulated interest on those payments. It's also known as the amount of an annuity. All right, so here's an example, and we're going to do this manually. So, and because there's a table involved with calculating these, because they're not all as simple, the numbers are not always as simple as this. So we're going to manually calculate the future value of an ordinary annuity. Here's the example. A bank is paying 8% interest compounded annually. Find the future value of $1,000 deposited at the end of every year for 3 years. So you can stop it and calculate this, and then play. So at the beginning of the period, there's nothing. At the end of the first year, the annuity is paid. There's no interest on that because it hasn't been in the account it was put in at the end of the period. So then we start the second period. There is $2,000 in the account now, but only $1,000 has anything at the beginning of the period. There is now $2,000 in the account because and interest is being taken only on $1,000 because the second payment comes in at the end of the period, so interest is only being taken on the first $1,000. Okay, so then we move on to year 3, and again, the same thing happens, but it's on the previous year's total. So $2,080, 8% times 1 year, right? That's time. And we get $166, and the total is $3,246.40, okay, manually. So if we want to use the tables, we're going to calculate, and this is the same as in the last chapter, calculate the interest rate per period for the annuity, which is the nominal rate divided by the number of periods. This example we just did is annual, so you're like dividing by 1, which is not necessary. Determine the number of periods of an annuity. It's the years times the period per year. So if it's annually, that's 1. I'm sorry, it's 3 years times the number of periods per year. So it's 3, sorry. And then we're going to go to the table and go across and down to find our rate. And then we're going to calculate the future value of the ordinary annuity by multiplying the payment times the factor. So let's give that a shot. So here are the tables and here are the factors. This goes through 10, and the second half of the chart table goes to 20, up to 8%. So here's the same example, but now we're going to look it up. So if we go 8% for 3 years, so we go to 3 periods because it's annually, and we go to 8% because it's annually. It's 3.24640. And so let's go back to our example. So it's 3 periods, 3 years times 1 period per year. The 8, it's dividing by 1 because there is only 1 period in the year. We find our factor, we multiply it by 1,000, and we get $3,246, just like we did when we did it manually. All right, so manually calculate the future of an annuity due. So now this one's a little different because this particular example, you have the money coming in at a different time. It comes in at the beginning of the year. Oops, sorry. So that makes things a little different. And we are now talking about $1,000 for 3 years annually compounding, and it's 6% interest. So we're going to go back up to the chart. So it's 6%. Right. So we're going to calculate the. It's 6%. So it's for 3 years. So it's 3.1836. And let's go back. And so now, I'm sorry, we have to do it manually. I jumped ahead, I'm sorry. So let's just do it manually. So we're going to, so now the money comes in at the beginning in the first year, and that means we take that interest rate. So you're actually gaining a little more interest when you're doing it in this this alternative annuity due method where the money is going in the beginning. So $60 gets added, then the amount comes in, and the interest is taken from that whole amount, not just from last year's amount. And we get down to the end and we get $3,374.62. And the amazing part is the interest rate is less, the deposited amount is the same, but your ending balance is more, right? Because of the annuity due approach to depositing the money at the beginning, not at the end. So that's important. All right, steps for calculating future value or the amount of an annuity due by using the tables. So this is important to notice this bolded area here. Calculate the number of periods of an annuity and add 1 period to the total, okay? Calculate the interest rate, period, nominal divided by the number of periods per year. That's the same. And then when we go to the table, we're going to find the number on the table, and we're going to subtract 1 from the ordinary annuity table factor to get the annuity due table factor. And we're going to multiply that times our payments. All right. Okay. So this adding 1 and subtracting 1 is very important. You won't get the right answer unless you do that. All right. So let's try a problem. It's back to the same problem. A bank is paying 6% interest compounded annually. Calculate the future value of $1,000 deposited at the beginning of each year for 3 years. So because it's at the beginning and not the end, we have to do some subtracting and adding, okay? So here's how we do this. 6% 6% divided by 1 is still 6%. Instead of 3 periods, we're getting 4, because if the money goes in at the beginning of the first year, it's getting the value of that, right? You're getting the opportunity to take interest on that. So we're getting 4 periods. We're going to go to the table, and it gets us this 4.37462, because it's now a different number of periods, right? So it's not the same as it was before, but we're going to subtract 1. So we get 3.37462, and we multiply that by 1,000, and it gets us this answer, which is what we came out with when we did it manually. Okay? All right, so moving right along. And we're going into section 2, and I'm going to start it because of the time we have left. All right, so present value of an annuity, ordinary annuity due above the given steps. Okay, so that means that if it goes beyond what the chart has. So calculate the interest rate per period for the annuity. Determine the number of periods, same. From the table, locate the present value table factor at the intersection and the number of rows, at the intersection. And calculate the value of the ordinary annuity. It's the present value ordinary annuity equals ordinary annuity table factor and annuity payment. Okay. So let's do an example. Well, here's the chart. So this is a different chart, and this chart has to do with the value of $1. So now we're going to actually be working kind of backwards, okay? And here's the rest of it up through 20. All right, so a theater wants, so this is when we're shooting at something we want, right? A theater wants $20,000 available at the end of each 6-month theater season for renovations and new stage and lighting equipment. How much must be deposited now at 8% compounded semi-annually to yield this annuity payment for the next 6 years? All right, so we have to follow the steps. And you can stop and do this on your own. I'm going to walk through the steps with you. So interest per period, it's semi-annually, so we're dividing 8 by 2 and getting 4. There are 2 of those in every year, and there's 6 years in this particular example, so we're going for 12 periods. We go and find that factor, and that's the value of $1 for this for this interest rate and these number of periods, but there's $20,000 that we want. So we multiply that and get $187,701.40. And that is the answer to the question, right? How much must be deposited? If we deposit this much money, that's how much we will be able to be paid, $20,000 at the end of 6 months for the next 6 years. So 20,000 and 20,000 is 40,000 in a year. And if you multiply that by 6, it's $240,000. So you're getting $240,000 of money for $187,701. That's the interest and the compounding and the whole, that's what ordinary annuity does. And so you're getting a lot more money for the money that you're depositing, okay? Okay, steps for calculating present value of an annuity due. We're going to calculate the number of periods of the annuity and then subtract 1 period. Calculate, so this is the same thing as before, only we're doing it this backwards, to see how much money we need. And it's the annuity due, which is at the beginning. That's the one that's deposited at the beginning. Calculate the interest rate per period. And we're going to find the factor, but we're going to add 1 to the factor, okay? And we're going to calculate the total amount, okay, the present value. Okay, let's give it a shot. So based on the sales and revenue expenses, I am not going to do this example. I'm going to go into the next video before it stops on me. I'll see you in part 2.